Hello and welcome to the Monday Futures Market Outlook for April 16th, 2012. This is Patrick Srezna. For those of you that have not had the opportunity to try out the eMiniSource.com trading room, complimentary memberships are available on the website. As always, we start off with a chart of the US dollar index and try to understand what the trend of the currencies are. Really, the entire year has been marked by a US dollar that has more or less stayed within even a 3-point range for the entire year. We continue to see that 78 to 78.50 act like a major support for the year. That is, in fact, continues to favor a bullish US dollar. We would need to see substantial weakness below the 78 level for us to really change our tune on the bullish US dollar stance in the bigger picture. In the same regard, we still have yet to officially change our short-term stance to bullish, because we want to see evidence that the US dollar is prepared to make a key break on the upside. When in fact we do go short-term bullish on the US dollar, we would be looking for targets even up into the 84-85 level on the upside to occur into the mid to late summer, if not into the fall. But we need to see a little bit more follow through on that US dollar. A lot of that will come from the way the euro trades, and particularly whether the euro makes a breakdown move right here. If we see the euro make a breakdown move, we may change our stance a little more bullish, anticipating a retest of that 82 level on the first target. Next year, when we take a look at the euro futures, you can see exactly what we're trying to talk about in the US dollar analysis, is that the euro is approaching that 130, 131 level and create this almost head and shoulders formation at the top of this wedge. Really at this stage, this is sort of like a line in the sand, because if this 130, 131 level does not behave as a support and inevitably gives out, it really does open the window for a new wave of euro weakness. While initially we would target the 126, 127 level, which is sort of where the lows came in back in January, but there certainly would be even room for the euro to weaken to lower lows if there is true momentum underway. It would be under the back of this euro weakness that we would see a very robust US dollar rally if it was to occur. Next year, I want to take a look at the 30-year Treasury bonds, and the Treasury bonds have continued to actually consolidate up at the top end of the range, above the 140, 141 level of support. This is going to be very interesting. The longer the Treasury bonds can hold above this level, the more confidence the bond bulls will get to taking it all the way back to the 145, 147. In many cases, though, these types of rallies still require retesting on the downside. So while we in the bigger picture and long term actually are bullish bonds, we are not 100% confident that this first rally here is going to actually be the starting point of the bigger, more robust rally. We could always still have a retest of some of the support lines below before a really bigger picture roll up of this market occurs. When we take a look at the commodities market, copper has made a key breakdown around that 370 level and continues to actually consolidate down there. We marked off that 360 to 365 level, which not only was sort of the zone where the highs came in back in December, but also it marks a retracement zone of the entire rally we had from December to January. This is a key level, because if copper continues to deteriorate below this level, then it would become almost deliberately and clearly biased to the downside in a full bear move. Under that premise, we would be very quick to want to change our short-term stance on commodities to bearish, as copper is one of the key commodities we watch to gauge where we believe the prices of commodities is heading. Next year, I'm going to take a look at the crude oil prices, and you can see crude oil continues to hold that 101 to 103 level, which we felt was extremely important to hold in the bigger picture. So long as crude oil stays above there, we certainly cannot rule out short-term strength that could see crude oil head right back to that 108 to 110 level on the upside. So we're not yet ready to throw in the towel on crude oil's potential upside move. It would take a substantial deterioration below 101 on the downside for us to really start kind of being concerned, just the same way we are with copper. And so let's watch whether or not the crude oil bulls can save the support line and give us a quick break above 104 to open open some short-term strength on the upside of oil. When we take a look at gold and gold futures, gold sort of continues to struggle down along this 1640, 1650, 1660 area. It continues to kind of rally back up and break down along this way. This is a kind of a crucial zone in the bigger picture, so long as gold can not break down these levels and roll back up. There is room for gold to work its way back to the top end of this range. But we, in the bigger picture, we're not overly bullish gold, but it would take a substantial break below 1630 for us to really feel short-term bearish on the downside of gold. So right now we were very neutral, looking to see where this range breaks for kind of which direction we're going to trade on the on bullion. That brings us to wanting to look at the S&P 500. As always, we start with that weekly chart going back 3 decades, and we plot an 80-week moving average on there. Does a very good job to depict the bull and bear market cycles we've gone through. Obviously, in 2010 and 2011, we had some short-term chop above and below that moving average, but the moving average in general remains trending higher, and we continue to trade above it, which it gives us, in the bigger picture, a clear bias to remain bullish, as there is no indication of a bear market move being underway. But that doesn't change our short-term concerns on the daily charts, but on these weekly charts, the trend distinctly is still higher. So then when we put up a daily chart of that S&P 500, we can see that we've now put in a short-term market top and have now broken a key trend line we were using to identify this uptrend. Really, at this stage, it's clear that we are underway in a corrective pattern. That where and how low will this occur? Well, naturally, market corrections last down to about 5 to 10% on the downside, and usually last anywhere from 3 weeks to even 2 months in duration. We're now almost 2 weeks into a correction that's not yet corrected 5%. So there is still plenty of room for this to deteriorate down to the 1320 to 1340 zone. And if given a catalyst, it could go all the way down to 1275 to 1290. But in our opinion, it doesn't necessarily have to go that deep. The bottom line is we are looking for further weakness, even if we have short-term rallies back to 1385 or even 1390. We expect that still to lead to further consolidation. At some point, this market correction will lead to a buying opportunity. We do not, at this stage, favor the bias that this will turn into some sort of a crash or very steep market decline. So it's just a matter of letting this correction run its course before we start committing our money into the marketplace. When looking at our key intermarket observations, for many weeks now, we've, on the short term, remained very neutral. We're seeing markets that are very range bound on all the major marketplaces. The US dollar has stayed very sideways. Commodities remain sideways. Bonds have been non-committal, and stocks have already reached the top end of their range. And so in fact, there's very little bias this week from last week in order to change that perspective. Now, if we saw the euro break that 130 level on the downside, it would certainly allow us to go short-term bullish the US dollar, and particularly if we see, let's say, crude oil and copper make breakdowns of those below those key levels we talked about, that would also quickly turn commodities short-term bearish. But the likelihood of us changing our stance on bonds and stocks in a short period of time is not likely. But the US dollar and commodities are at a point where we may change that short-term bias even within the next week or two. That was your Monday Futures Market Outlook. Thank you for joining me.